How do you pay for health insurance if you retire before 65? That one question keeps more capable people at a desk than any stock market crash ever has. You have the savings, you ran the numbers, one thing still holds you back, and it sits in the gap between the day you stop working and the day Medicare starts at 65. By the end of this video, you will know the 3 ways to cover that gap, what really drives the price, and the one move most people miss. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience. As a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant, you get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Here is the plan. First, why the years before 65 trip people up. Then the 3 real ways to buy coverage. After that, the income lever that quietly sets your monthly cost. Stay to the end and I will show you how to put a real number on this before you ever hand in your notice. Medicare begins at 65. Retire at 62 and you own your health coverage for 3 full years. Retire at 60 and it is 5. For most of your working life, an employer paid the bigger share of that bill and you barely saw it. Walk away from the job and the whole cost lands on you. That is the part the retirement calculators skip. They show your savings lasting to 95. They say nothing about the 3-year stretch that stands between you and Medicare. I was talking with a couple last year, both 61, plenty saved, house paid off. Their plan worked on paper. The only thing stopping them was a health insurance bill they had never once had to shop for. Do nothing, and this gap does 2 things to you. First, it can cost real money. Often, more than a mortgage payment each month for a couple in their early 60s. Second, and almost no one plans for this, your own income decides that price. The government ties the help you can get to the income you report, not to how much you have saved. Pull a large sum from a traditional IRA in the wrong year and you can hand back thousands in lost help. So the retiree with $2 million can pay full freight while the neighbor who plans the income carefully pays a fraction. Same coverage, different bill. The difference is planning. Here are the 3 doors between your last paycheck and Medicare. Door 1 is COBRA. You keep your employer plan for up to 18 months. Same doctors, same network. The catch is you now pay the full premium your employer used to cover, so the price can shock you. COBRA fits a short gap. Say you retire at 63.5. Door 2 is the health insurance marketplace, the plans created under the Affordable Care Act. This is where most early retirees land, because the income help I mentioned lives here. Pick your plan, and your reported income sets your monthly cost. Door 3 is a health sharing plan. These cost less each month, but they are not insurance. A group agrees to share medical bills, and they can decline to pay for things a real policy would cover. I had a client drawn to the low monthly price on one of these. We walked through what happened if he had a heart attack in year 1. He chose the marketplace instead and slept better for it. Quick note before the most useful part. If you are serious about retiring before 65, the video I point you to at the end covers the decision that pairs with this one, when to actually start Social Security. The 2 choices push against each other, and getting the order right matters. Keep watching, because the income lever I am about to explain is where the real savings live. Now the move most people miss. On the marketplace, your monthly cost is set by the income you report for the year, known as your modified adjusted gross income. Lower that number and your help goes up. So the question before you retire is not only how much you have, it is which accounts you draw from first. Spend a year living partly from cash and from a taxable brokerage account, and your reported income can stay low, which can lower your premium. Here is the tension. Those same early years before 73 are also the best window to move money from a traditional IRA into a Roth to cut the taxes you owe later. A big Roth conversion raises your reported income, which can raise your health insurance cost that year. You are balancing two goals with the same dial. A couple I worked with wanted to convert as much as possible right at 62. We slowed it down, kept their income under the line that protected their insurance help, and spread the conversions across more years. They paid less for coverage now and still cut their future tax bill. Before you hand in your notice, put a real number on this. Go to the marketplace for your state, enter your age and the income you plan to report, and read the monthly cost for a mid-level plan. Do it for each year until you turn 65. Add those to your plan as a line item, the same way you count property tax. Now the gap is a known cost, not a fear in the back of your mind. The rules on income limits and help change from year to year, so check the current year before you lock anything in. Health insurance is a solvable line in your plan. It is not a reason to give the job 3 more years you do not want to give. Get the number, pick the door, manage the income, and the path before 65 opens up. If you appreciate me making this type of content, let me know by gently tapping that like button. If this helped, the next choice to get right is when to claim Social Security, because it moves the same income dial we just talked about. Watch this one right here, where I break down whether taking Social Security at 62 is a smart move or a costly one.